The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box with Karen Cho and myself, Steve Sedgwick, and these are your Friday morning headlines. Well, a hotter than expected producer price inflation print, which goes along to the CPI inflation print, which was pretty hot the day before. Maybe. Is it raising concerns for the Fed? Well, it seems a slam dunk we're going to get a cut, but are we going to get one on the 18th? Anyway, the President-elect Donald Trump telling this very channel he's optimistic about the future.
You're going to see some very good days ahead. A lot of incentives are going to be given. You saw yesterday a $1 billion investment that would give you very fast approvals. Nobody's come up with that one yet, although it seems pretty simple.
And yet, Asian equities move lower and China's 10-year paper hits a record high as investors react to a lackluster readout from the country's Central Economic Work Conference.
The ECB delivers an expected 25 basis point cut, but President Christine Lagarde tells CNBC a larger move was on the table.
There were some discussions with some proposals to consider possibly 50 basis points, but the overall agreement to which everybody rallied was that 25 basis points was actually the right decision.
Germany's industrial sector takes another blow, with electricity prices hitting 18-year highs, triggered by a supply lull from renewables.
Good morning, Karen. I've got myself racking my brains for every 4 years whether it's like this as well. The extreme, and I'm going to say it, sycophancy towards President incoming Trump as well. And the lack of critique, the lack of criticism, basically from a whole host of people on Wall Street and in the US economy about how fantastic this presidency is going to be. It may well be. And I'm not getting political about this, but where's the criticisms about what deregulation can bring? Where are the concerns about the valuations that are being created in US stocks, which look for many in bubble-like territory? Where's the criticisms about what tax cuts can do in terms of more disparity amongst the wealth and indeed the rest in the United States, and how they are largely unfunded? Oh no, they're funded by tariffs, and how there is lack of criticism about what the tariff increase means for US inflation and for US consumers as well. At a time, and I'll just say the other side of the coin, when you've got chaos going on globally, you've got the Brazilians raising interest rates aggressively because their economy is cranking down, because they're worried also about inflation and a downtick on the economy at the same time because of Trump policies, because of the disparity that is being created with emerging market economies and their currencies versus the dollar. You've got Europeans who are cutting rates and probably not cutting them enough and getting towards levels where we're having conversations in Switzerland about negative interest rates, and the Chinese are underwhelming their economy, but no one on Wall Street wants to criticize the president potentially. And then to cap it all, you've got Zuckerberg, the enemy of Trump, giving him £1 million. What's going on?
Two peas in a pod, I would say, Wall Street and Trump at this stage. And we've seen what on the US markets, peak after peak. This is a market that is looking at all the upside around expansion of the US economy to all the success that AI will deliver for stocks and for company productivity. Trump, to your point, the incoming administration, there are hopes that this could re-energize the US economy, that all the deregulation.
Let me talk to you about re-energize the US economy. We've just had strong producer price figures. We've just had strong CPI data. We've got an unemployment rate of 4.2%. We've got growth rates which are outperforming the rest of the West by a country mile as well. I'm not getting political. I mean, Biden's made enormous mistakes, huge mistakes. In fact, I thought Biden was still the president, but he appears to have just disappeared somewhere as well. So, great criticism there for the other side of the coin. But what was so wrong about the profits that they were making on Wall Street under the Biden administration? The stock market has gone through the roof. But now everyone's saying this is going to galvanize growth. This is going to galvanize the animal spirit. We're going to have more M&A. We're going to have more activity. Well, for all of you who made shed loads of money under Biden, you may well make shed loads of money under under Trump as well. But let's not reinvent history. You've had a pretty good time on the last 4 years.
Well, the point here is that where were we getting to in the business cycle? And does Trump now extend that business cycle? And I think, to use a market term here, price to perfection. We're seeing that around Trump and around US market. So I think a lot of the positives are now what the market is looking at. And to your point, should there be a moment of consideration for the negatives? And I'll give you one yesterday around the AI story. Again, as we talk about Wall Street just looking at all the green sky, blue sky around AI, we had Adobe yesterday and there was a fade on that stock because the numbers did not meet expectations for the investment dollars. So the market looked at the efforts to monetize, but the reality was it was not in the numbers
and yet
just
Broadcom
yet.
surged. So, and that's a brilliant point. There are winners and losers, not winners and winners from the Trump administration, potentially.
Yeah, there will be some disruption, just like on the stock market. We will see some disruption in an industry and a stock level.
It may well be fantastic. And I'm not criticizing Donald Trump as such. What I'm saying is I'm criticizing the industry. I'm criticizing those who aren't questioning what it means. People have paid millions of dollars on Wall Street to question the politicians, to question the policies as well, to question valuations. All I'm seeing is this great big lovey-dovey herd who are saying it's going to be great because they don't want to upset the administration.
But the point is, are we now peak Trump and are we peak stock market? What does 2025 bring? Or is it an extension of the favourable factors for Trump? And if you think about what he's had over 2024, a coronation by the party early in the year.
Coronation by Wall Street now.
A coronation by Wall Street now. Coronation by Time Magazine, Person of the Year.
Which is fair enough.
There's a lot of
I don't mind the Time Magazine thing because that's absolutely right. They've looked at it and said this man has done something quite phenomenal and come back from the depths of January 6, 2020. Yes, he should be Time Man of the... I get that. But that doesn't mean to say his economic policies going forward should be carte blanche lauded by a Wall Street industry, which has paid a lot of money to make more criticism rather than just, as you say, coronation.
What I would like to question is whether the trades for stock market participants are as easy next year as they have been this year. And if you consider all of the moving pieces, how difficult this year has been from a news front, if you're running a company, there's been no shortage of uncertainty around geopolitics. But, if you just traded the same handful of stocks and just limit it to FANG plus stocks, you would have absolutely cleaned up, as well as just playing the S&P 500 or just playing the NASDAQ. Very, very simple trades to be had. Will 2025 bring the same easy execution for shareholders?
US producer prices rose 3% in the year in November for the biggest annual gain since February 2023. That's just one for you lot out there who are saying we're a slam dunk for a rate cut next week. That was ahead of economists' expectations for a 2.6% gain. Traders still pricing in an 95%. Look, this is my eye test. God, can we make the numbers smaller for all our viewers and for Anchor? 94.2%. I can read that. Hooray. 94.2% chance of a 25 basis point rate cut from the Fed next week. President-elect Trump became the first sitting or former president since Ronnie Reagan to ring the opening bell on the New York Stock Exchange. He was invited after being named, as Karen quite rightly said, Time's Person of the Year for a second time. Mr. Trump told a crowd of traders and executives that he was, quote, with you all the way, as he pledged substantial tax cuts. Just wondering, is he with Wall Street or is he with the rest of the economy as well, who are not necessarily going to get the same tax cut? Just checking you guys. I know you love him in Wall Street. Speaking to CNBC's Jim Cramer on the NYSE floor, Mr. Trump gave this message to investors.
You're going to see some very good days ahead. A lot of incentives are going to be given. You saw yesterday a $1 billion investment, and we give you very fast approvals. Nobody's come up with that one yet, although it seems pretty simple. I think you're going to have some great days ahead. We have to conclude a couple of bad wars that are going on. A lot of bad things are going on, but we'll get them done.
Well, let's take a look at that Wall Street action. It was finally a day in the red. These markets have been bumping along with intraday records on various different components. And what we saw in lockstep yesterday actually pulled back. So it was a modest retreat, so not a large-scale sell-off. But the downbeat session, well and truly noted, 0.5% coming off most of the major boards, a little bit more down from the NASDAQ. So no records by the finish yesterday. And over the course of the trading week now, we've got a Dow that's been in give-back territory, down 1.5%. 1.6%. And when it comes to some of the other major boards, the Nasdaq's been more resilient thanks to this rally into year-end in tech names again. It is still trading up by about 0.2% for the trading week, even with the give back yesterday. But we mentioned some big moving names to the downside. It was Adobe yesterday around that AI disappointment. Nvidia has also shown a little bit of pressure. That stock was moving to the downside for the S&P 500. And the other big stock to note, and of course there's been a lot of focus on this company in recent weeks, and this is United Health. That was the big moving piece for the downside. On the down, of course, there have been investigations going on around the murder of the CEO. Let's push on to what we're seeing elsewhere on the treasury markets. We are seeing 4.19% to the trade on the short end. The long end of the curve, we're 4.32%. Still a huge focus on interest rates into year end and just what the Fed will be delivering. Let me take you to the dollar. Dollar has been king, and that has been a story we're still seeing in this window against euro, where we're seeing slippage this morning, 104.61. It was somewhat of a wild ride yesterday, thanks to the ECB, as analysts took different positions on just what type of pathway we're going to get next year from the central bank. So you can see undermined there in the morning session again, and we're well off the 105 handle. Cable also showing a retreat down 0.1%. Dollar yen, that is a firmer trade. In fact, we've marched closer to the 153 handle. Dollar Swissy, where we had action yesterday from the SNB on rate cuts. Dollar is firmer morning session. Let's take a look at the oil trade for WTI and Brent this morning. Above the 70 handle on WTI, 73.43 on Brent. Gold prices have been somewhat of a sideways pattern the last 24 hours or so, and you can see morning session managing to gain some steam, up almost 0.2. Let's get out to JP Ong for the latest market action in Asia. JP.
Yeah, good morning, Karen. A bit of a forgettable Friday out here in Asia, mostly because of the same drivers we've actually been tracking that's really weighed on stocks. Now, we did see that stronger dollar actually blunt the FX space here and really led to weakness for many of the major currencies you're seeing at the bottom half of that wall. But the other policy or tone setter today was what came out of China or what did not come out of China. Again, we're seeing similar dance as all the craze in Shanghai and Hong Kong markets at the moment. You'll see a strong promise for fiscal support for the world's second largest economy. Markets rallying, suddenly we see a lack of detail that underwhelms markets, and you see the markets pull back once again. Now, at the end of that economic work conference, we did hear from policymakers that they pledge to increase the budget deficit in China and maintain economic growth. But apart from that, there was not much detail actually, and thus you saw the CSI 300 in Shanghai and also the Hang Seng Index in Hong Kong both pull back and close deeply in the red. Now, this also weighed on Australian markets, because we know Australia considers China their biggest trading partner, and we start to see softness coming out of the world's second largest economy. It weighs on the Australian markets. Miners from gold to iron ore were among the biggest losers actually on the ASX 200 in today's session. A bit simpler though for Japan today, and that's because the Nikkei 225 is coming off a 4-day winning streak. And after they briefly tested 40,000 for the first time since October yesterday, it seems that that traders there decided to take some profit and actually pull the Tokyo Bourse down. But keep in mind that this loss comes despite the fact that we saw intraday weakness for the yen, which usually supports equities there. But this time around, it seems that Nikkei fell down. The big surprise though is South Korea's Kospi, which managed to close in the green despite a lot of that political turmoil and instability there. But again, all bets are off if we start to see more of that political uncertainty ratchet up, because the president there is still facing impeachment, a push for him to be impeached for that botched attempt at declaring martial law. Back to you guys, and hopefully it's a better Friday for you out there.
Oh, JP Ong, I hope it is a better Friday for us if it's going to be downbeat in Asia. But yes, lovely. Thank you very much indeed. It's already better because we've had you. We saw two key decisions from central banks here in Europe yesterday. The SNB delivered a bumper 50 basis point rate cut, citing inflation data coming in below its forecasts, whilst the ECB delivered a 25 basis point move lower as expected. ECB President Christine Lagarde told CNBC, Annetta, that a larger move was discussed.
Inflation was really on track in terms of reaching our 2% target in the medium term. And, that gave us a level of confidence to actually decide a cut and to decide the appropriate cut, which is, in our view, 25 basis points. That proposal was agreed by all members of the Governing Council. There were some discussions with some proposals to consider possibly 50 basis points, but the overall agreement to which everybody rallied was that 25 basis points was actually the right decision.
City Wealth says 2025 will bring continued global growth and rising profits, but geopolitical challenges could create market volatility. Guillaume Menuet is the EMEA head of investment strategy and economics at City Wealth. Guillaume, I'm just going to go straight for it as well. I think Wall Street has crowned Donald Trump and is just loving everything the man says and loving every policy. I think they've by and large lost their analytical ability to criticize constructively what those policies could mean for the rest of the world. I'm probably wrong, but what do you think?
I agree with some of the statements you've made. I think generally investors tend to be a bit lazy. It's all about trends and momentum and replicating the playbooks that have been delivered in the first instance. So when you look at what the pronouncements are, and if you listen to what Trump was saying yesterday at the New York Stock Exchange, or wherever he was at the time, it's about good stuff happening because he wants it to. As the markets have delivered because the US economy has outperformed, is there any strong reasons to expect the US economy to underperform next year? I'd say no. So for investors, it's continuing the same trade, albeit, I think, with rising risks of valuation becoming overstretched in our view, certainly within the US large cap space.
So Guillaume, investors are, and I get the momentum trade. I'm not ignorant about it. I've been in markets for nearly 40 years. And it's lovely and it's great while it lasts. But deregulation very often leads to catastrophic events as well. Spending too much, as we saw with the sovereign debt crisis, which then got named the Great Financial Crisis, can lead to catastrophic results as well. But we're already seeing the world in turmoil, in part because of concern about Trump's incoming policies. Our viewers need to look at what happened in Brazil yesterday. They raised rates by 100 basis points because the economy or the currency is cratering, creating vast inflationary concerns, in part because the dollar's rallying, in part because of Trump policies. The ramifications, the ripple effect, the wave effect of these policies is already hitting the world, isn't it?
Yes, in some cases, with a negative tilt, as you just mentioned regarding Brazil. But I suspect that a lot of people will be focusing on the positives that let's say, peacemaking Trump could deliver for the world economy. After all, the biggest drag on, let's say, economic performance in Europe has been the much higher cost of energy since the start of the war in Ukraine. There are issues, structural issues with the business models, of course, and manufacturing's doing quite badly. But are we going to be focusing only on US shares in 2025? No, I think that the pronouncement needs to be, let's say, de-risked a little bit. We like US small cap, mid caps, as we have for the last 12 months. But I think the tilt in asset allocation is going to be hedging towards non-US equities gradually, as we think the global economy displays reflexivity. If financial conditions are loosening, we're going to see an improvement. And that improvement, I think, is going to see the valuations of non-US stocks in particular, alongside a slightly lower US dollar, play into the hands of international investors to refocus a little bit on non-US markets.
Guillaume, let's talk about cycles and timing, because a lot of this market feels to an extent like it's that final stage of the party where everybody pops open the rest of the champagne bottles and tries to enjoy it before it's lights out. There is a view in markets that, look, this is different this time. The lights are going to stay on for much longer because we've got AI, maybe a dose of Trump as well with his own policies. Where do you think we are at in the business cycle? And is there a danger of entering markets now because we're getting to the end stages of what have been fairly good times?
No, I don't think there's any risk of entering markets now. I mean, if you've not been in markets in latter part of 2023 and 2024 and studying cash, you've massively underperformed given what's happened in terms of a 60-40 portfolio. What you need to do next year is to be probably more diversified than you've been. You can't rely and build a portfolio would depend solely on S&P 500 returns. You need to broaden your investment horizons. You need to think about what the global economy is doing. The global economy, most likely next year, will accelerate a little from the levels of 2023 and 2024. And it's happening against the global backdrop where the global level of interest rates is coming down as well, a little. Plus, profits are probably inflecting upwards on a regional basis. I mean, outside of the US, So it's very difficult to, let's say, ring the alarm bells and say, don't invest next year because the markets are expensive. Markets are historically making new highs until they don't. But for now, we are gradually progressing. Now, earnings expectations look a little bit high to us on the S&P 500 for sure. I mean, we have a combined gain of, let's say, 14.5% for 25, 26. But that's not a market that's telling us that we don't need exposure to US equities. This is still the only market in the world that's delivering abnormal returns compared to trend. But there are parts of the market in terms of size which are cheaper, where there is quality, and we feel more comfortable with that still. So the overweights we have are still US 3%, and then non-US 0.5. But I think the tilt is going to be in the direction of non-US as we review asset allocation again.
Guillaume, let me ask you about the ECB, because it was a big one for markets yesterday, and analysts just took a very different view as to what they heard. Some thought it was not dovish enough. They didn't get the pathway around rate reductions that they wanted to see into 2025. Others thought that they'd pretty much served up as much as they could without being too explicit around the pathway. What did you make of what the ECB is likely to do into next year?
I think there was clearly a significant number of governors who had their fingers on the 50 basis point rate cut button, failed to argue their case perhaps as constructively as they might have. But it's the case of most central banks today when they look at the 21st of January. Nobody really knows what dish is going to be served by the end of the first months of 2025. So if you've got something in reserve that you can use at the time or be more clear about the strategy going forward, you're not going to lay it out for everyone being at risk of making a mistake because the Trump administration springs a surprise on you. So the same holds for China. But in Europe, we're going to see more rate cuts, certainly from the ECB. I think the standard fare is going to be 25 basis points at every meeting until they get to neutral, which is about 2%. And they could even need to go slightly below that.
Guillaume, thank you so much for joining us today and giving some things to stew on as we head towards next year. Happy holidays to you. Guillaume Menuet with us, EMEA Head of Investment Strategy and Economics at City Wealth.
Yes, his pitch was perfect given the fact that he's in a hotel room very clearly and he didn't want to shout. Well done, Guillaume, if you're still listening. Right, coming up on the show, Broadcom shares surge, as Karen was pointing out, the opposite of what we saw with concerns about Adobe. Anyway, booming demand for its AI chips. And that's what I've got the word of the day for you, and it's not Trump. Electricity prices in Germany hit an 18-year high as the country finds itself caught in a, wait for it, Dunkelflaute. It's a great word. I'm going to say it again. Dunkelflaute. We shall explain. And we're going to look ahead to the reinsurance landscape in 2025 with the CEO of Swiss Re. That is Andreas Berger. That exclusive conversation, 7:30 GMT.
Broadcom shares surged in extended trade after the chipmaker said it is developing custom AI chips with 3 large cloud customers. Fourth quarter revenue from its artificial intelligence business soared 220% to $12.2 billion. And the stock, as you can see, certainly setting off 14% higher. Apple is reportedly reducing its reliance on Broadcom, though, with plans to switch over to a new Bluetooth and Wi-Fi chip designed in-house. That's according to Bloomberg, which says that Apple's new Proxima chip, which has been in development for several years, will be introduced to products next year.
Volkswagen's board. This is a huge story if true. Volkswagen's board is reportedly leaning away from the idea of closing large factories. It would be a significant U-turn for the automaker if it does turn out that way, which is engulfed, of course, in negotiations with unions over proposed cost cuts. Now, this is according to Germany's Manager Magazin, which says board members are now looking at halting production at the 300-person Dresden plant and selling off its Osnabrück, a factory which employs around 2,300 people. Just quickly, given the fact that Bosch is talking about thousands of job cuts, it doesn't sound enough over at Volkswagen, so I'm fascinated to see how this one transpires. Meanwhile, electricity prices in Germany hit their highest level on record. on Thursday evening as the country finds itself caught in a so-called Dunkelflaute, which are days when the sun and wind levels are so low and gas and coal-fired power plants cannot sufficiently supply energy on their own. Prices surged to more than 900 euros per kilowatt hour, higher than at any point during the recent crisis. I'll say one thing, and I've said it before as well. This is I was very unpopular when I used to criticise Frau Merkel in the days when everyone thought Mutti, she's this amazing mother figure of Germany as well. But I was critical then, and I'll do it now as well. Her energy policies were a disaster for the country, and possibly a disaster for Europe, and possibly a disaster geopolitically as well. And I'll just talk about 3 energy policies very quickly. I'll do them very quickly. 1, the fact that coal is still a part of the mix in Germany when we know how filthy a fuel it is. 2, that they relied on cheap Russian gas and product for way too long, trying to keep the cozy relationship, trying to keep the Russians tethered to, which obviously emboldened Putin in many, many ways. Thinks Europe just could not fight against it if it made a move on Ukraine as well. And 3, and equally damning, is the fact that post-Fukushima, Germany decided to close its nuclear plants. And the last one's closed, as our producer David was telling us, under Scholz. But it was her policy that said nuclear cannot be part of the energy future of Germany. So the Energiewende for Merkel, for Germany, personally, and again, there are other views out there, I think it's been an absolute disaster and is leading to this problem now where, yes, absolutely, sometimes there is no wind. Absolutely, sometimes you do have cloudy conditions where you're not getting enough photovoltaic capacity as well. What a mess.
Resilience. It's something the Germans need. We saw the height of the crisis around energy, electricity for the country back in 2022 to the point where we're talking about whether we should start to stall some of the factories trying to save some of the energy requirements just in case it was a cold winter. So, fast forward to today and then you'd think there'd be a little bit more resilience. But here we go. There's a spike and an escalation in the price because of a lack of supply. Just to add this to all the other stories we've been talking about, having enough renewable storage capacity. This is a big one, and maybe some of the audience roll their eyes when we talk about renewable storage capacity. It doesn't sound like the sexiest story in the world, but the reality is if we're moving to a future relying on renewable, you need to have some sort of backup plan. And is it around storage? Is it about having more combinations when it comes to renewable, whether nuclear and some of these small reactors need to be part of the mix, and whether you do need a large-scale rethink on nuclear policy? The other big point is around the economic story here, because what you're seeing on the ground in Germany is, again, what we're talking about. The debt break, the investment requirements, a lot of this is going to remaking the energy grid. And you've got a situation now where it's clearly having an impact on the country. It's having an impact on competitiveness, on pricing, the ability of the country to have a strong economy. What type of investment do you need in this type of environment? Because, one economist was saying to me, and, government circles do not like hearing this, if you're ripping out investment, you're ripping out infrastructure, replacing it with new infrastructure, that's not actually doing anything on productivity for the country. And here we have a situation where this infrastructure does need support. So it does tell you about the challenge economically that Germany has just to get going on its energy grid, its energy infrastructure, let alone growing the economy from here.
Yes, absolutely. Can't disagree with any of that. What a great new word, Dunkelflaute as well. I knew Dunkel, but I didn't know Dunkelflaute as well. Germany's got some of the best words. What are the best German words? I got called one at school by my teacher quite a lot in German. So what is it? Wanderlust? He didn't call me that.
No.
Schadenfreude? That's a pretty good one as well. Zeitgeist, we talk about that all the time.
Yes.
One I got called at school a lot was Dummkopf. Never did find out what that meant.
I think there's a little website that you can use for translation.
I think I got my German O-level, Karen. I got a B. I know what Dummkopf means. Shame on you, Mr. Teacher.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekomete, weekdays on CNBC.